Welcome to our CFP exam prep discussion. Today we're diving deep into a crucial insurance concept that often appears on the exam: insurable interest, specifically its timing requirements for different types of insurance. Let's break down the concept of insurable interest. At its core, insurable interest means having a financial stake in something or someone that would cause you financial harm if it were damaged or lost. Think of it as a legitimate reason to want to protect something through insurance. What many test takers get wrong is the timing of when this insurable interest must exist. For life insurance, insurable interest only needs to exist at the time the policy is initiated. This makes logical sense when you think about it. A parent always has an insurable interest in their child's life when they take out a policy. Even if that child later becomes estranged, the policy remains valid because insurable interest existed at inception. Here's where it gets tricky and where many candidates make mistakes. For property and liability insurance, insurable interest must exist both when the policy is initiated and at the time of the loss. Let me give you a practical example. If you sell your house but keep the homeowner's insurance policy active, you cannot collect on that policy if the house burns down after the sale. Why? Because you no longer had an insurable interest at the time of the loss. A common exam scenario involves business insurance. Consider a business partner who insures company property. If they sell their stake in the business but maintain the insurance policy, they cannot collect on any subsequent claims because they lost their insurable interest. The exam often tests this concept through scenario-based questions. They might present a situation where someone's relationship status changes, property ownership transfers, or business partnerships dissolve. Your task is to determine whether a valid claim can be made based on when the insurable interest existed. Here's a key tip for the exam. When you see an insurance question involving timing, immediately ask yourself two questions. First, what type of insurance is involved? Second, when does insurable interest need to exist for that specific type? Let's look at some real-world applications. A spouse has insurable interest in their partner's life when taking out a life insurance policy. Even if they later divorce, the policy remains valid because insurable interest only needed to exist at inception. However, if that same spouse had insured their partner's jewelry collection and they divorce, they cannot make claims after the divorce because they no longer have insurable interest in the property. Remember this distinction by thinking about the permanence of life insurance versus the changeable nature of property ownership. Life insurance deals with an irreversible event, while property can change hands multiple times. A frequently tested mistake to avoid is assuming that all insurance types follow the same rules for insurable interest. The exam loves to present questions where this distinction matters. Always remember, life insurance, inception only. Property and liability, both inception and loss. In your exam preparation, pay special attention to questions involving business partnerships, family relationships, and property transfers. These scenarios frequently appear and test your understanding of when insurable interest must exist. Master this concept, and you'll be well prepared for questions about insurable interest on the CFP exam. Keep practicing with different scenarios, and always remember the timing distinction between life insurance and property liability insurance.